Picture your portfolio. You've split your risk evenly. One standard lot on USD, another on GBP USD. Textbook diversification. You're protected. Then, a single US non-farm payroll report drops. Within seconds, both trades hit their stop-loss limits at the exact same time. Holding both pairs turned a single macroeconomic swing into a double tax. You paid twice for the exact same move in the US dollar. Welcome to the reality of 2026. The traditional relationships between currency pairs are actively rotting away, a process known as correlation decay. Relying on textbook diversification strategies today creates a dangerous illusion of safety. Behind that comfort, you are sitting on massive, hidden exposure to the exact risks you tried to avoid. Look at this equation. A plus 0.85 correlation score converts two similar charts into a directional multiplier. Opening one standard lot on two pairs correlated at plus 0.85 merges the positions. You have effectively opened a single 1.85 lot position against the US dollar. Because plus 0.85 correlation means these pairs move in near lockstep, their stop losses are structurally bound to trigger together. This synchronicity drives the probability of a double loss up to 90%. This underlying math has become severely punishing in 2026 due to macro fragmentation, the fracturing of global monetary policy. Look at these divergent paths. The Federal Reserve is battling sticky service inflation, while the European Central Bank is dealing with energy-led stagnation. Instead of moving as a herd, global central banks are pulling in opposite directions. Even historically reliable anchors have failed. The Swiss National Bank explicitly broke away from shadowing the euro to focus on internal price stability, destroying the old mirror effect, where the Swiss franc would predictably follow European flows. Global central banks operate on their own isolated timelines now. Using old historical math to predict their alignment guarantees you are over-leveraging your account. We can see this fracture clearly in the commodity markets. For decades, the Canadian, Australian, and New Zealand dollars moved together. Today, as a unified cluster, that unity is completely gone. Their economic drivers have completely split. The Canadian dollar remains heavily tethered to fossil fuels and LNG exports. Meanwhile, the Australian dollar has pivoted, becoming a primary proxy for green tech manufacturing metals like lithium and copper. If you try pairing the Australian and New Zealand dollars based on old correlation data, you are walking into a trap. You inherit severe liquidity issues and massive slippage on the New Zealand side, gaining zero strategic advantage for the extra risk. Some traders try to game this fragmented system using a synthetic hedge, going long on perfectly negatively correlated pairs, like URUSD and USD-CHF, assuming they are fully protected. This ledger shows exactly why that fails. In a dead trade with a negative 0.95 correlation, the inverse currency movements mathematically cancel out any profit to zero. Meanwhile, you are forced to pay the broker spread twice. Building clever, static hedges based on dead historical relationships mathematically ensures you are paying double just to tread water. The root cause of these traps is an error in timeframes. Traders are taking one-year historical averages and applying them to short-term, 3-day trades. To navigate 2026, we use this dynamic grid, a rolling 30-day matrix. It compares 90-day structural baseline data against 30-day immediate market reality. If the 30-day metric drops below the 90-day baseline, you have an active decoupling, warning of a false breakout. True portfolio diversification happens in a very specific mathematical safe zone. Identify currency pairs with correlation metrics strictly between negative 0.20 and positive 0.20. Practically, this means mixing a major US dollar pair with a cross pair, like UR/JPY. This specific spacing insulates your entire portfolio from collapsing over a single headline about American interest rates. Look at your open positions. Do you know their current correlation? Run an immediate risk audit. Stop guessing. Download the FXNX Dynamic Correlation Matrix tool today and open an NX1 account to execute your trades with institutional-grade zero-spread technology.